All right, welcome back. We are at step three of creating a tax strategy, and this is coming from a high level. So there's going to be some nuances that we may not get into in this video, but keep following us for subsequent videos on how all of this comes together. So what do we do in step one? We created a vision. And this vision is pretty much what is it that we want our business to do? We can add the life part in, but the life part is more in the wealth strategy. But what do we want to do? What problem do we want to solve? And how can we see this now? That's the key. Like you have to see it first, because if you don't see it, just like many entrepreneurs, many business owners, this is missed. Most people don't have a tax strategy. Look, I've reviewed hundreds, if not thousands, of tax returns. I've looked at them, thousands actually, thousands of tax returns over my career. And there was a time when I did not understand this. So there are many accountants that still don't understand it. But so in that time I didn't understand it, man, if I would have. Now, when I finally came into the light and I realized that, hey, something's not right. I just knew the basics, but we got to actually show people what they need to do and really how they can get there. And as accountants and tax preparers and really just money people, we got to help them. So the vision is everything. What was the second step? It's the map, right? It's the entity map. It's kind of like, okay, well, how are we going to structure all of this? Bam, 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 bam. How many? It's like 6 entities. You're like, Jay, that's a lot of entities. Don't worry about that. We're trying to save you money. And now once we have the vision, we have the map. What's next? Here's what's next. Now is to just know what are the deductions that we can take in our businesses. All right. Rule of thumb. Here's the rule of thumb I'm going to give you. And this is the biggest key. The first thing we have to establish when we're looking to make a deduction in our business is this. This is the number one thing. Are you ready? Are you ready for this one? Business intention. Write this down. This is the number one thing that will get you a deduction. Business intention. Now, I was just on the phone with some new clients, and I was talking to them about some stuff and introducing all these new ideas to them, because all this was new. And they were just like, wow, our other accountants never talked to us like this. They never helped us. They never showed us what it meant. They never educated us. I said, don't worry about that. They didn't know. So don't hold it against them. And so what we did was I started sharing with them things that they could do. And I was like, oh, great, great, great. So we did this thing. Can we write this off? I said, well, here's the problem. You didn't have a business intent before you did it. Oh, what do you mean? But we wound up doing some business. I said, well, here's how this works. Especially when you're talking about anything personal. I want you to think about this. Every time you have a personal expense, before you spend the money, say to yourself, like before you spend the money, is there a way for this to be a business write-off? You got to ask this question first. Don't go spend the money and then try and write it off. Because now you're really, look, at the end of the day, we want to be honest about what we're doing. So it's the first step is establishing that this is going to be a business expense. So business intention is everything. And I'm going to give you one thing I learned from one of my attorney friends. And he's heavy in tax strategy. And what he said was this. He says, Jay, check this out. I was called to go and do a speaking engagement. And so had on his calendar, he's going to do the speaking engagement. And so he gets up to New York and he finds out that that he's a week early for the speaking engagement. So he wound up staying in New York that weekend or whatever, did some things, came back home. He asked the question, is it a write-off? Is it a deduction? The answer is yes. Why? Because his intention, even though he was a week early, his intention was to go there for a speaking engagement, which he wound up having to come back. So both are going to be a write-off. But here's the other side of it. But what if I just go to New York? What if I go to New York and then all of a sudden while I'm there, remember, I've already spent the money for the plane. I've already spent the money for the hotel. I'm already spending money. And then I say, hey, I want to write this off for business. Why don't I do some business here? He says, Jay, you didn't have a business intent before you went. So the business intention happens first. Like if you don't get anything else, like you have to get this here. The business intentions. This is the most important step in your tax strategy. The intention for business. Because here's the next thing. People ask me all the time, Jay, what can I deduct? I say just about everything. I can deduct everything. Just about everything. Because when we add in the business intent, now there's nuances in tax strategy and deductions and how some deductions work. However, hey, but if we got the business intention, then we're going to deduct just about everything that we put our money out for. I mean, are you catching this? Like rich people that are serious about this, they invest a lot of money in professionals so that they can make sure that they don't miss anything. So just about everything's deductible. I'm going to go with you just a few deductions that many people mess up or miss. So one of the first things, this is not even a deduction, this is a structuring. So there's the S corporation structuring. Now here's the thing, don't do this alone. This one you don't want to do alone. Here's why. Because you could easily mess it up. And sometimes people do it too early, and sometimes people do it. Well, I'm gonna teach you, you'll be able to do it by yourself, but people do it and then they don't understand exactly what the compliances are. So make sure you get some help here. But I'm going to do as much as I can to help you through the S corporation. So the S corporation is a way for you to save a boatload of money on taxes. So let's just say it like this. If you had $100,000 profit in your business, we're calling profit. This is after expenses. At 100,000 profits, you had your LLC. You're going to get taxed 15.3%. 15.3% of self-employment tax. That's 15,300. Now, do you now that's in addition to your income taxes. So typically a person like that single, could easily be paying 25, really almost $30,000 in taxes on 100,000. You want to do that? No, I don't. No, you don't. So why don't you do this? In a case like that, you convert your business from a single member LLC, or even if it's multi-member, to an S corporation. Now, here's how this works. That $100,000 profit, all you have to do is about 30% of the 100,000 needs to go in payroll. So then you take 30%, which is going to give you 30,000, and then the 70,000 you don't have to take in payroll. So you get to save. It's roughly about $10,000 you get to save when you convert to an S corporation. When you have those numbers. So just imagine those, like the numbers are getting bigger and bigger and bigger. Like, yeah, man. I mean, we've saved people $20,000, $25,000 when we helped them convert and they didn't know it. Like recently, $250,000, we were able to save them $30,000 in taxes because they started working with us. So now, S corporation. What else? You got things like your kids. Like if you have kids 7 to 17 and even younger, like say for instance, if you have a baby and using them in marketing photos, like you can hire them into your business, right? And you can pay them up to almost $14,000 every year, tax free to them, and a deduction to you. This is huge. Just imagine all the things you're buying for your kids, right? You're buying things for your kids. You're spending money on, especially the kids that that do basketball, football, soccer, cheerleading, all volleyball, all the stuff the kids like to do, and you're spending all this extra money. If you bring your kids into your business, then you can write that off in your business. But you can't go and write off those things. So in essence, you hire them so you could basically you're writing off all the extracurricular stuff and even private school when you have your kids in private school. So now, if you're paying private school money, which now you get to deduct that in your business. What else? Meals. Meals is huge, right? Because meals you're always eating. Like we eat here, like in our office, we could be eating at lunchtime and sometimes working late. Those things are deductible. I can deduct the meals that I'm eating, even though I'm at home, even though I have a home office, right? I'm going to deduct my meals. But here's the thing. It's just like when you work for corporate America. I used to work for corporate America and they would bring food in and people would eat food during the day. They wrote that off. That was a business expense because they were just feeding the people as they were, hey, everybody can have some lunch. Sometimes they would do it later in the day. You can do the same thing, right? So meals is huge. What about your car? right? Your car is a tax write-off. Now, here's the thing. What if, a lot of people ask me this question, well, Jay, what if the business doesn't own my car? Great. It doesn't have to. Just say you've already started your business, you already have a car. You know what you can do? You can take the car, you can say, hey, even if you have a loan on it, doesn't matter. You can contribute your car as equity. Contribute your car into the business as equity. That's your way of paying it. So say for instance, you bought a car, it's a year old, maybe you spent 30,000 for it. And, depending on what kind of car it is, depends on the treatment of it. But just say you took it and hey, I'm just going to give it to the business as equity. You don't have to change the title. You don't have to do any of that. Now that's one way of doing it. You go buy a car. Jay, well, I'm not able to get favorable terms. I can't put it in the business name. No problem. There's a way that we could then get the company to reimburse you back for the cost of the car with depreciation. That's something that you may need some help with, but that's the way to do it. You can reimburse yourself for the car because when you buy the car, now here's how I like to work with my clients. If you're going to buy a car, buy it at the end of the year. Don't buy it during the year. It's going to get harder. You get less, especially if you drive it personally. Now, if you're going to drive it 100% for business, then no problem. You can buy it anytime during the year. But if you're going to buy the car, buy it strategically at the end of the year, right? You buy it at the end of the year. And when you buy it at the end of the year, then what you can do is you can drive it once for business and it's 100%. You get 100% write-off. So now, I may just say you had an SUV, it's over 6,000 pounds. You're going to get 80%. That's 2023. You're going to get 80% write-off for the cost of that car. Now, here's another thing. What if you just lease it? Then you can get the lease payment. You can get reimbursed the lease payment every single month. When you want to do that? All right. So that's the car. There's a plethora, guys. This is amazing. Three other deductions, and then we're going to jump off. So the next one is your home office. Home office. Even if you have an office outside of your home, we call this the administrative office, where what you do is you pretty much do administrative work at home, just about 10, 12 hours a week, and you're golden. Then you can get a percentage, and you can get, especially when you're an S corporation. When you're an S corporation or like a corporation or something like that, you can get a reimbursement for the use of your house, right? For the use of your office, which could be extra $300, $400, $500 a month, right? Just on the home office, right? So just got to know that there's a couple ways to do it when you're doing the home office. It's not just a percentage. You could do the room method. The room method, how many rooms you got in the house, right? Whichever one is better. You got 8 rooms in your house. You got, one office. You divide that. That's your percentage. Because a lot of times the percentage might be lower, right? The percentage just might be lower. So if that's the case, do the best one. So what did I just share with you? I shared with you can do the regular square footage method, which is the square footage of your office versus the full square footage of your home or your apartment, whatever you live in. Or you can do the room method. How many rooms do you have in your house? The total amount of rooms in your house versus the one divided by 8, 10, whatever that is. And then that percentage is the percentage that you can use for all the expenses that you incur in your home. So that's a home office. What else? Rent your home to yourself. Didn't we just do that? No, you didn't. Rent your home to yourself specifically for, you have to have an LLC for this. Like if you don't have an LLC, you can't do it. So you have to at least be an LLC in order to do this. Well, you can reimburse yourself back for renting of the home. Now, here's the thing. This is not renting of your office. You have to use other parts of your home. You want to use your living room, your dining room. Maybe you're using a part of the kitchen, whatever. So you basically get to reimburse yourself for renting the house for events. What kind of events do? You can have a board meeting. You can have a company meeting. Any kind of meeting that you want to have, you can have it in your home. And if you have it in your home, then you can get a comparable rate, which say, for instance, I was going to use the hotel. I'll go and get some comparables at the hotel. And I can find out, wow, the hotel is going to charge me $1,500. The hotel is going to charge me $3,000. The hotel is going to $4,000, right? So now I can say, oh, well, I'm just going to reimburse myself $2,000 because I had like $1,500 or $3,000. Everybody's calling right now. Of $1,500 to $3,000, and you know what I'm saying? Like that is the cool part when you're talking about making these deductions. So that's called the Augusta rule. If you didn't know, that's the Augusta rule. But that's rent your home to yourself, and you got comparables. You have your meeting, and here's how you want to do this. You want to have a memo. Um, all of our private clients, we give a memo to, so all they got to do is fill in the information. But I'm going to share with you what's on the memo. What part of the house you're in? What's the date? What'd you talk about? Who was there? And what are the action items? Those are those are some of the things that's going to be in your memo when you do a meeting in your home, and you can do this up to 14 times a year. So say for instance, you had 2,000, you can get $2,000 every time you do this meeting. 2,000 times 14, right? What was that? 28,000. $28,000. That's what you can deduct on you. Like that's compensation to you. That's 28,000 tax free to you. Wouldn't you want to do that? All right. So now you have the last one we're going to talk about is medical. So the medical reimbursement arrangement. This is a big one, especially for people that are in business. Now, here's the key. This only works. This works the best when you just have family in your business. Doesn't work as well when you have regular employees, because you have to offer this to everybody that works at the company. So if you only have family, and we can show you how you can still have a regular business with a different strategy and a family business that actually does it all. So that's something that we also help you do when you're one of our private clients. So basically what you get to do is write off all the insurance, all the health insurance, the dental insurance, all of the co-payments, all of the expenses that you may have to go for prescriptions, and even like cough medicine, anything related to health, chiropractic, anything related to health. You need to get massages and stuff like that. All of those things can be deducted 100% when you have a medical reimbursement arrangement. And this is what we help you do. We got a separate company that we work with that helps us implement it the right way, because you want to make sure you do it the right way. You don't want to mess this one up. And so the medical reimbursement is one of these things that most people don't get because there's extra paperwork, guys. And when you're talking about saving boatloads of money, then it's going to cost you a little bit more. Now, there's many other things that you can do. There's retirement strategies. There's all sorts of strategies that you can use when it comes to saving money on taxes. These are just a few strategies that I know that a lot of people miss and don't necessarily get and understand when it comes to making sure that they pretty much take back the money that's theirs. So we've gotten to the end of this journey. This is not the end. This is just the beginning. So what did we learn in the past few videos? We learned that you got to have a vision. And really, I may not have stressed this. It should be compelling to make you want to work in a way that you can really be strategic in your taxes. So that's the vision. Then it's the entity map. It's just mapping out how the business looks structurally. This is important. And we talked about up to about 6 different companies, which could be even more than that. Like people like now, we're not getting bogged down in how many companies that you have, because every strategy is going to be based on the individual and what you want to do. So we don't make you do anything. We just say these are the best practices. These are some of the things that you just want to prepare for. And then lastly is the deductions. What do we learn mostly about deductions? Business intention is the most important thing. That's it. If your business intention is right, you can deduct just about everything. And then we ran through a few of the things that you want to do, want to make sure you're looking at: the S corporation, the meals, the vehicle, the home office, to rent your house to yourself, the medical reimbursement arrangement. These are major deductions and major structural things that will help you to save boatloads of money on taxes so that you can put more money back in your pocket. So guys, I thank you for being with me for this short journey. Look, be on the lookout. Make sure you share these videos, or make sure you subscribe to the channel, because look, we're here to help entrepreneurs. We're here to help business owners, especially those that have a calling on their life, people who want to do something great. We just want to make sure that you keep more of your money by way of taxes. So guys, I appreciate you for joining me, and I will see you guys on the next video. Peace.